Just a quick intro overview about our webinar series. We do these at least bi-monthly at least. And so if you haven't been to our YouTube channel, it's YouTube. You can go and type in Protect Wealth Academy and check out our videos there. We archive these and try to make sure we provide the best up-to-date information for you. Our upcoming 3-day Asset Protection Summit, fantastic event with, I'm not kidding, some of the best brains and experts on asset protection, taxes, estate planning, and of course, Mike Koval is there on the markets and how to look at the investments. You'll see tonight, he's brilliant. One of my favorites, always Mike, with Dr. Danko, the author or co-author of The Millionaire Next Door. That's always fun. One of my favorite books I read when I was in college. Love that book. You'd be surprised how many different strategies in there if you just pay attention to it. Kind of fun. And then Clint Coons and on asset protection. Scott Estel, he's a former senior trial attorney from the IRS. He's tried thousands of cases against the IRS. And I guess he says he's never lost. He had one draw, but he's never lost. That's a pretty cool record. So
that's the guy you want to get. That's the guy you want to get to know.
That's the guy you want on your team, for sure. No doubt about it. So pretty good team. Of course, Don Pendleton is a guru on asset protection and tax planning and tying estate planning, and all three of those all together, which you won't get from your average CPA or accountant or attorney. They may know taxes, they may know asset protection, they may know estate planning, but tying all three together can be very difficult because what's good for taxes isn't always good for asset protection and vice versa. So you have to have, really, that's truly, we find a lot of crazy things that work great for taxes, but you can get crushed in asset protection. So it's why it's really good to have someone in your court who can do all three.
It's kind of cool looking at that picture is that, a lot of people say, I can't learn, so it takes too much time to learn something, but you look at the team up here, and this is like kind of like a dream team of everything that you want to know, especially with the economy and finance and you're running your business. It's nice to have a team like this that has all the answers for you. You're not expected to know everything. You're supposed to, it's not what you know, it's who you know.
Totally is. Like we were saying before we got started, education is what separates the average from the wealthy. It's not a whole lot different than education. Constant education, you'll find that from the Jeff Bezos, the Mark Zuckerberg, all those names, whatever you want to say, the multi-billionaires of the world, the wealthiest of the world. One of the main things they always say, and this is true in The Millionaire Next Door, they spend more time than the average on education. So, and that's not formal education. That is money education, finance education. All right, so upcoming events, August 1st, 2nd, and 3rd is a live stream. September 12th, 13th, 14th, another live stream. Today, well, that's after COVID. Zoom's been a good thing because we can reach a lot more people anywhere, in your living room, on the beach, wherever you're at. If you're at work, if you're working out, whatever you're doing, you can listen to the summit. That's why we love the live stream. It's been a huge blessing for us to reach more people and get it out there, this message to everybody who needs to hear it. But if you're tired of that, if you're zoomed out, come in October. So October 10th, 11th, and 12th, we'll be in Phoenix at the Phoenix Hilton Airport. This will be our live event of the year in person, our only one of the year. It is $99 a person, just because, of course, costs are outrageous for the hotels. But we'd love to have you. If you can come, please come and see us in person. Disclaimers, of course, we're not giving specific legal, financial, investment advice. This is not specific to you. So if you're looking for advice, seek out a legal, competent professional or investment advisor, whoever you're looking for. That's why I bring on the experts like Mike. So we're excited about tonight, a message of hope, Mike. And I believe that is absolutely true. When I heard you last week talk about some of these things briefly, I felt like it really was a message of hope. And there's no reason to panic. There's so much opportunity right now in the market. So if you know what you're doing, don't panic. It's good to have you on the team, Mike. Thank you so much for being here.
Thank you. So tonight, as I go through this, I want this to be kind of participatory so you can ask questions along the time.
Perfect.
And if you can, please go ahead and use the Q&A section, not the chat section, because I won't be looking at that. But if you have a section of the Q&A, go ahead and leave that, and I'll be happy to go ahead and answer that for you.
Yeah, chat's been disabled. I'll post a few things in there as we go, but it's been disabled, just Q&A. And you're fine to ask questions throughout then, Mike. That's okay?
Yeah.
Okay. All right. Go ahead. Thank you so much, Mike.
All right. Thanks, Kendall. All right, so I'm going to go ahead and tonight we're going to be talking a little about investor education, profiting with inflation. Giving yourself a little bit of that hope. And like Kendall said, I have had a lot of emails and phone calls and stuff coming to the office about people kind of panicking right now about what's happening in the overall stock market. And if you were on any of our classes that we did here with Protect Wealth at the end of last year, October, November, December, we were covering specifically why the market has to drop in just the next few months. And obviously starting January 1st, everything we talked about kind of fell into place. Now that it's been dropping, we're in a bear market right now. Nice little rally today because the markets were closed yesterday. So you had 2 days worth of movement on it. But how much longer is it going to drop? We have inflation. We have some things that are coming out in the stock market right now. Things that are making people nervous. And am I going to be able to afford gas? Am I going to be able to afford, food and groceries? How much longer is this going to last? Type of stuff. There's a few very specific things that I want to cover. Same things we covered at the end of last year that we can cover now as well. But we're looking at them with a different set of eyes because we've already had that drop. So what we're really looking for is there anything that tells me how much longer the markets might continue to drop? And that which means it'll affect both our stock market and our housing market at the same time. And inflation will continue to go up. When should we be seeing that start to turn? And what signals should I be looking at? And once you have these signals down, they work consistently decade after decade after decade. They don't change. The same type of signals. So I want to cover some of those with us tonight. Before I do, I need to make sure I cover disclaimer. Everything we cover is for educational purposes. I'm not recommending you go back and buy anything tonight based off of our training here. I just want to make sure that you understand that this is an educational class and this is to be used for your personal gain for the rest of your life. And once you have that, what I think you're going to find is it's going to take away all the fear and panic that people have in the marketplace. I know that in my business, I travel a lot. So I'm on an airplane, we're traveling a lot, we're going different places. And when we do that, one of the things that I used to really dislike the most, when the airplane pulls back from the gate and it pulls back 2 or 3 feet and just parks and it doesn't move. And the reason they do that is they say that they can now say that they left on time. Now sometimes they sit there for a whole hour and they say, we're waiting for a thunderstorm to come through. We're waiting for another airplane to come through. The captain decided we had to have some service come on board. They had to service something on the aircraft or move some luggage around, whatever it might be. But you sit there for a while. And because they now say that you're on an active taxiway, you're not allowed to get up and move and do anything. So you're kind of just stuck in your seat for an hour. What I learned after a while is that if I brought on my phone, downloaded some movies on Netflix or Amazon Prime on my phone, and brought something in my bag, a couple energy bars or something in the bag to eat, and then sometimes you get upgraded to first class, because I travel a lot, not always, but sometimes you do. So there's a bottle of water sitting right there. So now when the airplane pulls back and they say, okay, sorry guys, looks like we're going to sit here for a while, and then they just sit there and they don't even tell you why you're sitting there. So it shouldn't be too long. And then an hour later comes by and the captain says, well, we're doing this and we're almost close and probably just a few more minutes, but they never give you an exact time, just a few minutes. Well, it used to be really irritating because you can't control it and you're just stuck there and you can't move. But when that happens, I just pull out my phone, put in my ear sets, get myself an energy bar, get myself something to drink, and I've got dinner and a show while I'm just sitting there. So you can watch a whole show in an hour and a half, and it alleviates that pressure that you have, saying I'm just stuck and I can't do anything. Well, the stock market's kind of the same way. When you're watching your portfolio drop and the money managers say, don't worry about it, you're in for the long haul, but they're still charging you to manage your money while they're forcing you to lose money like that, it's fearful and you get irritated and you get antsy and you don't know what to expect. And you're thinking, should I even go out and buy some more groceries today? What type of thing can I do? But because of all that, there are some certain things that you could be looking at right now. It tells you when that's going to stop dropping. And if we know what those are, we can actually move to cash and leave our money in cash until we see those signals. So the market's not losing us any money. And when we see those signals start to change, we can start to go back into cash or back into the stock market at that point in time. You're not going to be perfect. You're not going to catch the absolute top or the absolute bottom of the market, but you'll get the majority of it and you'll get that peace of mind. And so that's what I want to cover tonight. I want to go over through some of those items and what we can go back and take a look at. And a lot of the stuff is known and we could fix a lot of it. We just don't because Congress decides to do some kind of weird things sometimes. A lot of that's forced by Wall Street. Wall Street makes them do certain things that we were talking about at the very beginning here. Wall Street is neither Republican or Democrat. Wall Street is Wall Street. They will elect people into office to make sure that those people will write bills and pass laws so that Wall Street gets to do what they want to do. So here's a good quote from Warren Buffett. He said, I could actually end the deficit in 5 minutes. You just pass a law that states anytime there's a deficit of more than 3% of the gross domestic product GDP, all sitting members of Congress are now currently ineligible for re-election. Why don't they pass that law? Because it would end the deficit. And the answer is because they want to get reelected and they don't really care about the deficit as long as they get reelected. So they'll spend, so they get the votes, whatever they need. And so not always a good thing. So the point is, we don't always do what's proper. And so that means that Wall Street does that, Congress does that, everyone does that above us. So if that's the case, I'm not saying that we can fix it immediately, but if we know that, we can work with it. So let's talk about some of the things that are in the stock market that you need to take a look at, not on a daily basis, but on maybe a weekly, monthly basis that tells you the stock market's about to fall or it's about to go up. Now, these are some longer term things, so not on a, oh, today the market's going to go up or down. So I'm trying to keep this simple. I do talk fast, which is good news because this is recorded. So Protect Wealth is going to post this so you can watch it over and over and over again. But the stock market's is a pretty complex machine, but it does have some basic fundamentals that every single investor needs to understand that you are never, ever, ever taught. So I'm going to cover them, and then you'll have these forever. I'll keep it fairly simple, but no, it's much more in depth than what I'm going to cover here. But I'm going to keep it simple so you'll say that starts to make sense. And now when you listen to CNBC or Fox Business News or hear a radio announcement or read an article, you'll say, I understand why they're saying that now because it goes back to the 4 points we're going to cover tonight. Now, when you hear people say they reference the stock market, here in the United States, if they're talking about professional money manager, when they reference the stock market, they are specifically talking about the S&P 500 index. You're going to hear them say the Dow Jones, which is 30 large industrial companies, or the NASDAQ, which is basically our technology exchange. But when they reference the stock market, professionals are specifically talking about the 500 largest companies in North America that are considered the benchmark of the whole U.S. market. And they're from retail stocks and industrial stocks. They're technology stocks. They are healthcare stocks or automobile stocks. They're the biggest 500 companies from every major sector of the U.S. marketplace. And so that is the stock market, it's the S&P 500. You're going to hear Dow and NASDAQ. You'll also hear New York Stock Exchange. And that's where a lot of these stocks trade at. So the S&P 500 is an index with 500 stocks. It's a big basket. And so how did this big basket of stocks close? Did it close up or down? Which way is it moving? And you can actually put it on a chart and see which way that chart looks like with the biggest companies out there. Now, those 500 companies trade on a couple of different exchanges. The NASDAQ exchange, which is where more of the technology stocks come from. And you'll see those because if a stock has a ticker symbol, like on the screen here, Amazon, it has 4 symbols on it. Amazon, Baidu, eBay, Netflix, Google, Microsoft, Apple. It has 4 ticker symbols. It's a NASDAQ stock. And so there's over 3,200 stocks on the NASDAQ. You might hear also the New York Stock Exchange. So that's where a lot of really big companies are that are not technology stocks for most of them. You're going to hear it be called on the big board today. And the big board just means the New York Stock Exchange. But when you walk in, it's just a great big huge board that you see over the top of the trading floor. So it's also called the big board. But if a stock has 3 ticker symbols to 1, it's like IBM, Boeing, JP Morgan, Walmart. That's called the New York Stock Exchange. And so there's about 2,800 stocks on there. Then we have a lot of smaller companies, which are the New York Stock Exchange Market Exchange, which is a lot of small cap companies that are newer companies. But specifically, when we say the stock market, we're talking about the S&P 500 index. Now, if we want the stock market to go up, we need more buyers than sellers, and vice versa, going to go down, more sellers than buyers. Now, when we say buyers in the stock market, 95% of all buys and sells in the stock market come from the institutional money managers. These would be the hedge funds, pension funds, insurance companies, mutual funds, and investment banks. They control 95% of the entire stock market. Whatever they do happens. They are the market. So the market goes up, it's because they were buyers. If the market goes down, it's because they were sellers. 5% of the rest of the volume is just us, retail investors, people like you and me. We don't control anything. It doesn't matter what you think, it doesn't matter what you do. What matters is whatever the institutions do. So if you know what signs they are specifically looking for that tell them to buy long-term or sell long-term, you'll be able to copy them and make money without having to say, what good stock should I buy today? Right? What did Jim Cramer say on CNBC? Nope, I want to copy the institutions because they're the ones that control the market. Whatever they do is what happens. So what are those signals that they go back and take a look at? So for the rest of this year, and kind of what do we expect? And here's the signals we're going to go back and take a look at. For the rest of this year, I do expect to see more volatility through the rest of summertime. June, July, August, and into September, which means we're probably going to still be a little bit lower between now and the end of summertime. And I'm going to cover the reasons why, and then what to look for that says it should now be starting to change. So between now and the rest of summertime, I do expect that the stock market will be lower at the end of the summer than it is today. That could change. There could be some news that comes out. Something's going to change on one of these numbers I'm about to give you right here below that, and it could change that. But if I see those numbers start to change below in this section right in through here that I'm highlighting right now, if I see these areas right here start to change, any one of those 4 items, that means the stock market might have bottomed out and starting to rally. And so at that point, so will the housing market, because of the mortgage rates as we're going to go through that. Let's go back up. All right. So what are we going to watch for? Now, by the way, end of the summertime, I expect the market to be a little bit of a bottom. At that point, from the end of summertime, I'm hoping that we kind of find a bottom and we slowly start to gain a little bit of momentum into the end of the year. Originally, I thought the market would be higher at the end of the year than it is today. I'm not seeing that now just because what the Fed has recently done and said over just the last week. So I am expecting a little bit of a bounce into the end of the year, but not a huge bounce, just a little bit of a bounce. So in other words, the selling should start to subside and we'll see a little bit of gain in the end of the year. So what are we going to look for? And I'm going to cover what each of these items are on here. And then I'm going to show you how we can then use it to make money. Because making money isn't difficult. It's just different. Nobody's actually really sat down and said, here's the signals that make the markets go down. And when they do, this is what you do. Here's the signals that make the market go up. And when they do, this is what you do. Now, you can get better at that. You can get into technical analysis and read charts and be really good. And I love that technical analysis part. But for the long term, if you're a long-term investor, there are some signals that say, hey, if I've got my portfolio, this is part of my retirement, what should I be looking at? So if I'm thinking about getting ready to retire, what should I be looking at right now? Tell me that my portfolio is about to drop and I have to keep working, or I should sell what's in there and move to cash to protect it while the market goes back and drops. So we're going to start with the Fed discount rate. And the Fed discount rate is the first one you're going to take a look at. Now, with the Fed discount rate, I only want to see, is it increasing or decreasing? So let's talk a little bit about what that is and what that means. So I'm going to go back on a little bit of a story here. We're going to go back all the way to 1907. For those of you who don't know what the Fed is and how the Fed works, prior to the Federal Reserve Board, the Federal Market Open Committee, FOMC committee. So prior to this, let's go back to about 1907. And for those of you who might have been watching some old black and white Turner, classic movie television shows, do you remember when they had this section? They said the banks were failing. They had what's called a run-on banks, and what happened where the banks were just closing, people couldn't get their money out. You guys remember that? Well, that kind of started back in the early 1900s when a lot of immigrants were coming here into America, and they were bringing their customs and their money and things like that with them. There were no big rules about who could have a bank and what a bank was and how a bank was able to run. So you actually had areas, especially in like New York City, where you had just a block of one area where everybody knew each other. And on that block was a bank. And that bank was made up of just at some point, just a loan shark type of person who said, yeah, I'll run a bank for just this block. And they could have whatever they want. They made up their own money. At that time, there were over 3,000 different types of currency in the US in the early 1900s, 3,000 different kinds of currency outside of the US marketplace. Even today, it's not illegal to print new currency. You just can't reprint the US dollar, but you can create your own currency today if you want. It's not illegal. It's just that nobody will probably say, oh, I want to use that currency because it's not using. But back in the early 1900s, there was over 3,000 different kinds of currency. And no specific bank was saying, here's the rules, here's how this works. It was just whatever each bank wanted to go back and say they were doing. So what happened was some of those banks started to close down because they weren't doing a very good job managing the banks. And when you hear that, and let's go back, 1900s, and you're an immigrant, you don't have there's no internet out there, there's no TV out there that you're going back and watching. And all of a sudden, someone next door to you knocks on and say, hey, the bank's closing down. So what do? You run down to the bank real fast to withdraw all of your money. Well, the banks don't have money just sitting there. They loan it back out. That was their job, but they just weren't doing a good job loaning it. They were losing money. So when people kept drawing the money out, the banks just said, we're closing the doors. And at that point, they closed the doors, and that would freak everybody out. So people on the next block, they'd run to their bank and grab the money, and they'd take as much money out, and then that bank would close the doors. Then you had that going all across the nation, people reading about in the newspaper. So everybody across the United States was just yanking money out of the banking systems, and the banks were just going insolvent. There was just called a run-on banks. The banks were just closing one right after the other. And so at that point, there was no set rules. The government wasn't in charge of the banks. Just anybody had their own bank. So nobody really knew what to do. So at this point, J.P. Morgan, John Pierpont Morgan, you've heard the name J.P. Morgan, agreed to finance only insolvent banks. So what he said was, I will go ahead and I will help these banks. And so he said, because he had a little bit of money, but he said in order to do this nationwide, he went to the U.S. Secretary Treasurer, his name was Cortelyou, and he said, who was at that point overwhelmed with trying to find out what was happening and fix the banks because there was no real process. But JP Morgan was a big banker. His dad was a banker. His father was a banker. His father was a banker, from overseas. They knew what they were doing. They were running very successful banks here in New York City. And so he went to the Secretary of Treasury and said, I'll tell you what, I will help you as a banker. And my father's a banker, and his father was a banker, and his father was a banker. We can fix this problem you're having with all these banks closing the doors and people panicking and freaking out nationwide. But in order to do that, you're going to have to print up money, U.S. Treasury Department. You have to print money and give it to me. And then I will go out and disperse that money. And my team of bankers will go out and disperse that money to other banks to fix them and show them how to be proper banks. But he said at the same time, we will only go back and fix the banks that we want to fix. In other words, he said, we don't like this bank over here. We're actually going to let them go belly up. And it was agreed to. So the U.S. Treasury Department printed up money, gave it to JP Morgan Bank. And then they went out with bankers across the U.S. and they helped put money into those banks so the banks didn't have to close their doors, which stopped people from freaking out, panicking. And then they taught those banks how to stay open, but they forced out of business all of their competitors because they didn't want them out there, which gave them a little upper hand. Now, once that panic was over, and this is going with how the Fed works, once that panic was over, it prompted Congress now to do what they do, form a committee. So they formed the National Monetary Commission to review the U.S. banking policies. This commission was chaired by Senator Aldrich, who in 1910 took 6 prominent bankers and scholars to a place called Jekyll Isle off the East Coast, out of Carolinas. And here's where it gets kind of weird and how the Fed works and why people don't know about the Fed. When they went out there, now this was from the National Monetary Commission formed this. And so Senator Aldrich took a group of people out to Jekyll Isle and said, let's create now a new banking policy that will now run the banks across the entire United States. And let's form this. And so let's go through what we were actually hired to do. But what's weird is they went to a secret island and they told everybody they were going there for a duck hunting trip. But they weren't there for duck hunting. They were going there to form the Fed and having the Fed take over banks all across the United States and telling U.S. Treasury Department what to do. So the reason they did that, and so it was a duck hunting trip, was because they wanted to be able to write rules and pass the laws that was in their favor. And so it's kind of a weird situation how the whole thing started. It wasn't until 1930 when somebody found some paperwork behind an old desk that was back there that actually talked about what happened on Jekyll Island and how these individuals created the Fed. So now, you might have heard the term The Creature from Jekyll Island. It's a good book if you want something to read. Part of it's on tape as well, so audio like Audible, you can go back and listen to it, which talks about the Fed and kind of where it came from and how it works. Now, here's what the Fed is. I have a red line that says the Federal Reserve. It has a red line through Federal Reserve because it's not a government agency and it has no cash reserves. But if you call it the Federal Reserve back in 1913 when it was created, you would think as an American that, oh, this is the US government passing a bill so that the US government will help the banks out. And it's not. It's a group of private banks that has nothing to do with the US government. So December 23rd, 1913, the Federal Reserve Act was signed into law at 5 p.m. So kind of a weird thing again. So this was signed into law December 23rd, 1913, 5 p.m. So let's go back to what is December 23rd, day before Christmas Eve. Well, if you're in Congress and you're a senator or congressman and you want to get home to your family for Christmas Day and there are no automobiles, there are no planes back then, and you had to leave across the country, how did you do that? By train. How long did it take? More than a day. So who was actually there on December 23rd at 5 p.m. to object to this bill that was being signed? Nobody. Everybody was gone. So it was kind of passed in secrecy because nobody objected to it because nobody was there to object to it. It is not part of the federal government. It doesn't have any reserves. It's a private organization that now controls the U.S. monetary system, setting interest rates, bailouts, and issuing currency. It's just a series of banks that now control the U.S. monetary system. So what we did is we took control away from the U.S. government and we gave it to a series of private banks. How do we do that? By passing a law December 23rd, 1913, 5 p.m., and creating the whole thing in secrecy on Jekyll Isle. Congress and the president are not allowed full oversight of the Fed. The Fed runs autonomous and they control themselves. So here's from the 2009 Senate hearings, and maybe some of you guys are familiar with this. Do you remember back when the entire stock market crashed and the housing market crashed back in 2008, 2007? What happened was the Fed said to the U.S. government, print up $2.2 trillion. So the Fed went to the U.S. Treasury Department and said, U.S. Treasury Department, print up $2.2 trillion and give it to us, the Fed. Now, the way the law was passed in December 23rd, 1913, the U.S. Treasury Department has to do whatever the Fed says. So the U.S. Treasury Department printed up $2.2 trillion and gave it to the Fed. And now everyone to know, what did the Fed, series of private banks, do with all that money? So this was a hearing on C-SPAN, and it's Bernie Sanders here asking the Fed chairman at that point of time, saying, will you tell the American people to whom you lent 2.2 trillion of their dollars? And will you tell us who got the money and the terms of the agreement? And the answer was just a flat no. And there's nothing that they can do to make the Fed chairman say, here's where $2.2 trillion of US money went to. The Fed doesn't have to say that to anybody because they're a private organization, and that's the way the law was passed. Who controls the money? Remember what we said? Follow the money. Whoever has the money sets all the rules. The Fed sets their own rules. So now, who is the Fed then? That seems kind of weird. So who is this Fed? The Fed is a board of governors, 7 of them, and 12 regional banks who are each responsible for their district. Now, I live down here in Southwest Florida, down here where my mouse is down to here. So the Fed for our system here is in Atlanta. So this is the Atlanta Fed is responsible for every bank in this green area. So if you're a bank in this green area, you answer to the Atlanta Fed. The Atlanta Fed does not have to answer to the Dallas Fed, who doesn't have to answer to the Kansas City Fed or Chicago, Minneapolis, San Francisco Fed. They run each individually all by themselves. They work as a group, but they run individually. Now, there are a board of 7 governors. Now, here's where it gets kind of weird. But if we go back to each Fed, you say, well, who is each Fed? Well, if we just take the New York Fed, that's Chase Manhattan, Citibank, Morgan Guarantee, Fleet Bank, Bankers Trust, Bank of New York. Those are the top Fed banks in New York City. So whatever the Fed goes to the U.S. government and says, U.S. government, print up $2.2 trillion and give it to us, the Fed, those series of banks, take 6% right off the top and just give it to themselves. And say, yeah, we have the golden goose, we're taking 6%. Now the rest of it, that 94%, we will do whatever we want, such as loan it out to other people or use it for borrowing for other things out through there, but they will then control the rest of that money however they see best fit for themselves. And they tell the U.S. Treasury Department how much money to print up and how much to give to them. And the U.S. Treasury Department is not allowed by law to say no. So that seems kind of weird. So there's got to be some checks and balances in this, we say. The reason I'm covering this is because I need you to understand what the Fed does when you hear about it and what it means for us in the stock market. There's 2 branches of the Fed. There are, so kind of go back and look at this. Whoops. There we go. Board of Governors and the 12 regional banks. So 2 branches of the Fed. The 7 board of governors, they're appointed by the president and they're conferred by the Senate. So back in 1913, when this bill was passed, we as Americans said it must be okay, because at least we have some control over these big banks because it's got 7 board members on there who are appointed by the president and confirmed by the Senate. They work with the private side, which are the private banks, those other 12 banks that we just kind of covered through there, and the regional banks. Each regional bank is responsible for their own district. Now here's the part. The 12 regional districts do what they want to do. The 7 board of governors here, they have 0 voting rights, 0. They're just there as a token so that we as Americans say, oh, we have somebody that's appointed on the Fed board here, so at least we know what's going on. Yep, you know what's going on, but they're not allowed to vote. So they don't get to vote. The banks vote themselves, and whatever the banks vote on, they get to do. And whatever they vote on, the U.S. government has to comply with what the banks say. The Fed is not part of the U.S. government. It is its own regional private business that tells the government how much money to give to themselves. How cool is that? Walk up to the IRS and say, hey, I'm not giving you any more money. I'm just going to go to the Treasury Department and tell them, give me $1 million. And the Treasury Department has to say yes. They can't say no. Does that just seem crazy? That's what the Fed does. Now, the Fed does actually have a job, and here's where it gets into the stock market and the housing market. What the Fed does is considered to be the central bank of the United States. And I'm talking fast. If you have a question, just kind of throw it up through here as well. But I do talk fast. Good news is you can watch us on the recording over and over and over again. Fed is considered to be the central bank. It tries to maintain confidence in our monetary and banking system while maintaining a healthy economy. The Fed supervises all banks. Said, is this bank solid? Does it have enough money? Is it loaning out too much money? What's it doing? And just kind of make sure the banks are strong so they don't go under, so that we have confidence in our banking system. It also sets bank reserve rates and how much it actually loans money to itself and at what rates it loans money to itself. Sets all interest rates and loans money, regulates money demand. They actually have a job. Now, here's why it's important for us, because the Fed sets interest rates. In other words, when you hear what's called the Fed discount rate, that means how much money the Fed gets money from the U.S. government, goes to the U.S. government, says, print up to the U.S. Treasury Department, print money and give it to us. Now that the Fed has that, it loans it to itself, other banks out there. And then it says, how much money is the Fed going to charge those banks for the money? Obviously, they're in it for a profit, so they don't charge too much. But when there's economy is too hot, I mean, we're growing, the Fed says we can't grow that fast because we'll eventually implode. For those of you who have a business, you want your business to grow at all times. You want your business to grow, but you don't want to grow so fast that you can't keep up with it. As the business grows, that's called growth. Now, the Fed calls that growth inflation. We don't want the economy to grow too fast. And we're going to cover inflation here in just a moment. So the Fed wants the economy to always grow at all times, but at a manageable rate. 2% is their ideal target. When it starts to get over 3%, they say, hey, we're going too fast. We might have to take a few steps to slow it down a little bit. But 2% is their ideal goal. So when it starts to grow too fast, one of the things they do is they say, let's raise the interest rates. Now, June 15th, they raised the interest rates by 75 basis points. And 75 basis points just means 0.75. A basis point is point. So if we say it was raised by half a basis point, it means 0.50. So the Fed raised interest rates by 75 basis points, or 0.75%, which was huge. It hasn't done that in 28 years. The last time the Fed raised interest rates 0.75 point was 28 years ago, which tells you how bad the stock market has to be when on June 15th, they raised interest rates by 75 basis points. It means that the Fed's saying the markets are going too fast. They can't keep up. Inflation's too much. Gasoline's too much. Rent's too much. Everything's growing too fast. And the Fed says that's going to implode. Just like your business can't grow too fast, our economy can't grow too fast, or it implodes. So the Fed says, here's how I slow it down. We will do what's called monetary policy. You heard the term monetary policy, which means they won't go to the Treasury Department and say, print up money and give it to us. So the Fed says, we're not going to ask for money, which means we're not going to loan it to ourselves, which means if we don't loan it to ourselves, when you go to the bank, it'll be harder to get a loan. You're going to have better credit. So fewer people will be able to borrow money for houses and cars and things like that. And when you do get to borrow that money, it's going to be at a higher rate because the Fed is raising the interest rates. So not only will it be more expensive to borrow, it'll be harder to get the money. So what happens then as a retail economy, we will just stop buying things. And when we stop buying things, supply and demand states, nobody's buying, prices are going to have to stop rising and start to go down. That's called opposite of inflation, recession, if we get to be too low. But deflation is really what we're after. So deflate some of the inflation. Then we'll start to go backwards. So right now, the Fed raised it by 75 basis points this last week, which is the highest they've done it in 28 years, which tells you it is so bad they had to do something they haven't done for nearly 3 decades to help slow this economy down. That's bad news. Now, here's where it gets a little crazier. July 27th, next month, is the next Fed meeting, and they already forecast they're going to raise it by another half a point, 50 basis points. Now, it hasn't been since 1994 that the Fed has raised interest rates a half a point or higher twice in a row, which means that, again, we're really bad off. Our economy is growing way too fast, and the Fed has to just smash it to get slowed down. They also, or some analysts are saying, it might be 3/4 of a basis point because the Fed came out last week and said, we raised it this week 3/4 basis point. It's not off the books. We might have to do it again in July if we don't see a slowdown. But we do forecast 50 basis points. They said the same thing will probably happen in September, the same thing in November, and 1/4 point in December. So what that means is you've got 3/4 point, at least another 0.25, so that's 1.25, 1.75 basis points, 2.25 basis points, another 2.5% higher by the end of the year, another 2.5% higher. Add that to now what? 2.5% higher. Add that to your mortgage rate. What's your mortgage rate going to be now when you start to go back and get something? If we're going to go another 2.5% higher than we are right now. So just tells us that if the Fed's raising interest rates, they're telling us that the economy is growing too fast. When it's growing too fast, what happens is everybody in the stock market knows it's going to drop. So when the economy grows too fast, big institutions, hedge funds, pension funds, insurance companies, mutual funds will say the markets are going to crash because they know it's going to crash. So what they will do is they will start to sell stocks because they know, in large quantities, by the way, because they control 95% of the market, they will start to sell stocks because they know if they don't, it's going to crash anyway. So let's sell now while it's really high. And so they start to sell. And by the way, when they start to sell in large quantities, what does that cause the stock market to do anyway? Starts to crash, which is kind of a self-fulfilling prophecy. So when you see the Fed saying they're raising interest rates, it means the economy is doing too well and they're trying to purposely hurt the economy. So when the Fed says we're raising interest rates, expect home prices to get hit and the stock market to drop. So that's the first thing we're going to go back and take a look at is what's happening with that. Let's just go back here and take a look just right now at mortgage calculator. So I'm going to click right here. I've already clicked there. I've got a browser open up. Let me see if I can find that page that's on here. And we will go with, nope, don't have it. So let's click on it. I'm going to click right here, open up a new browser for us. See if I can find that. There we go, and change my screen share. Screen share. Where are we at? Here we go. All right, so now you can kind of see the page I just clicked on here. It's mortgage loan calculator. If I go right here in the very middle where it says rates, right here where it says rates, and it just tells us what the 30-year mortgage rates are right now. If I kind of scroll down, it says as of June 17th, so last Friday, as of June 17th, current 30-year fixed rates right around 6.5%. 6.5%. Yeah, Tammy, your portfolio should already be on 20%. Yeah. Most of them dividend stocks, which is a good idea to go with here. But we're going to show you when stock market should start to drop on it or stop dropping. So 30-year fixed is about 6.5%. Now let's go back up from here and go to the calculator portion and just show what that means. So if I've got a house, and let's say that we're going to take a loan out here of about $300,000. $300,000. On a 30-year fixed at the current interest rate, it's about $1,900 a month for that loan. Well, only a couple months ago, that was 3.5%, which means that the same mortgage for the exact same house just 2 months ago, this is only for principal and interest. This is not your taxes and insurance. It's only the PI, principal and interest. 2 months ago, that was a $1,343 loan. And 2 months later, because the Fed has now raised interest rates twice, it's already $1,892. So it went up another $500 just over the last 2 months. The exact same house is now $500 a month more on a $300,000 house. Wow. What if that wasn't a $300,000 house? What if that was instead, what's the average house price in America right now? A little over 400, about $420,000. Current rate for just principal and interest alone is $2,600 a month without taxes and insurance on the average house right now. Now that same house was $1,881 only 2 months ago. Exact same house. And that's because the Fed's raising interest rates. So what does that mean? It means that people aren't going to be able to afford as much houses anymore. It's going to cost them too much money. Not only is it going to cost more money to get into a house, it's going to be harder to actually get the money for the loan because the Fed says we're going to stop printing up money and give it to the banks. So if we kind of go back now to where we're just at. So a lot of people say, well, my house prices are still doing okay. Right now, a $500,000 loan 2 months ago at 3.5% was $2,200 a month for just principal and interest alone. That same house right now, for at 6.5%, is $3,100, almost $3,200 a month. Look at, went up almost $1,000, around about 45% increase just because of the interest rate so far. So that same house that was $500,000 for $2,200, for the same $2,200 loan, you can only afford a $355,000 house now. You can't afford the same house you could in the past, just because interest rates gone up. But remember, they're going to raise it another 2.5% before they're done. Where could that interest rate be right now, which is currently at 6.5%? Where could that rate be? Let's just go back and take a look at our mortgage calculator. Let's change this now from 3.5 for a $420,000 house, $1,800, to let's go up now, just go to 8%, an 8% loan. Just a flat 8% is now $3,082. Wow, $3,082, where before it was $1,886, the exact same house. Could you imagine what's going to happen with the real estate market? It's going to be harder to get that loan. Yeah. It's in a Roth IRA, so no tax benefits for losses. No tax benefits for losses is correct. So we think about that. And the reason I tell you this is because if you say, hey, I'm investing in real estate as well, understand that home prices are going to drop because people can't afford them anymore. When they can't afford them anymore, they're going to stop buying them because they can't even get the loan to begin with because their credit's not enough, which means that their supply is going to start to go down, or supply is going to go up because nobody's buying, and home prices are going to drop. So this is where the two kind of go hand in hand here with the stock market. So when we talk about some of the things we're interested here, I want you to understand that it's your entire marketplace, the entire economy is what we're after here. So Fed, what we're trying to see here on the Fed, kind of what to expect in the Fed, biggest raise they had last week was in 28 years, and they might even do it again next month. So watch the numbers. The Fed discount rate, is that number increasing or decreasing? If they say that the Fed is raising the interest rates, expect the stock market to go down longer term until they stop raising them. Once they stop raising them, we should soon, after they stop raising them, we should start to see a bottom after they stop raising them. But as long as they're raising them, what they're saying is the economy is still growing, and we need to punish the economy and hurt it so that it won't go up. Because if it keeps going up, they're going to have to keep raising interest rates at an even higher rate until it finally goes backwards, because they go in opposite directions. Interest rates go up, stock market goes down. Now, at the same time, the Fed says just the opposite. If the Fed starts to lower the interest rates, they're trying to get you to buy. And when they're doing that, then because you buy, profits from the companies make profits, stock market goes up. So they work opposite. Interest rates going up from the Fed, stock market, home prices down. Interest rates going down, stock market, real estate prices going up. So that's the first part that you want to go back and keep an eye on. And it works long term. Next one is the inflation. You hear the term all the time. Now, these are things that once you have these, you'll be good for the rest of your life. And you're not going to say, I'm a day trader with this information, but you say, hey, I'm trying to prepare long term. Should I be in the market? Should I be buying new homes right now? No, you should wait for the home prices to start to crash a little bit. They're not going to crash like 2008, but they're going to sell off a little bit, which just gives you a better entry, is what I'm trying to get to here. So the next one here is called the CPI. CPI is another word for, what is it? It's called the Consumer Price Index. It's the generic term for inflation. So when you hear the term inflation, really what they're talking about is the Consumer Price Index. The Consumer Price Index, CPI, measures the monthly change in prices paid by U.S. consumers. In other words, how much are you paying for things? It comes from the U.S. Bureau of Labor and Statistics. It calculates the CPI as a weighted average of prices for a basket of goods and services representative of aggregate gross pricing. The CPI is the most widely used measure of inflation. It's what most people use. So when people say inflation, most of them are talking about the CPI. There's a few other things they'll throw in there, but most of it strictly is just the CPI. It's closely followed by policymakers, including the Fed, financial markets, businesses, and consumers. The CPI is based on about 94,000 different prices collected monthly from 23,000 retail and service establishments, as well as 43,000 rental housing units. And it's calculated on a monthly basis. So we see on a monthly basis, is that amount going up? Is it costing us more this month than last month in order to buy the same basket of goods? And if that number is increasing, it starts to look bad. Now it comes right here from bls.gov/CPI. So I'm just going to highlight that and go to show you exactly where it's at, because I want you to understand these, and you're going to keep these 4 items. It's just 4 items, all you have to look at for the rest of your life, for your long-term portfolio. From there, you decide which way how you're going to invest type of thing. So let's go back now to here and type that at the very top. BLS website. Go down here. It says on the right-hand side, Consumer Price Index over here on the far right-hand side, and click on the charts. From here, we're just going to scroll down the page. I'm sorry, click on the very first one here, Consumer Price Index Summary. So we're after. And then scroll on the page, and what we're after is, move this out of the way. What we're after is right here. This top number, right-hand corner, 8.6%. In other words, it's costing you 8.6% more this month than last month to buy the same things. And that number has been increasing month after month after month after month, which means that the economy's growing too fast. It's costing us way too much money to get things. And so if it's costing us too much money, we can't keep up, because eventually we as individuals say, I can't afford it anymore. And that's when everything starts to implode on us. It just goes the opposite way. The Fed doesn't like that to happen. So when they see that number increasing, they say that's bad news. So what will the Fed then do? So let's go back now to our screen. So what will the Fed do when that number starts to increase? They'll start to raise interest rates. So the Fed wants that number right around 2%. That's what they want, 2%. Cost of goods should always grow about 2% at all times. Now, and that means because you're getting raises and you got other things coming out there, you're getting house prices increasing to offset the raises that you have along with that. You got stock market that's increasing with your house prices along with your job raises to kind of offset that 2% that we go through here. But the Fed always wants 2% because we want to see growth. As long as we have growth, that's good news. We just don't want to be so fast. Typically, any number, we go back to our next slide back to here, any number over about 3.5%, when that number is at 3.5% or higher, at that point, CPI, inflation, at that point, the Fed will say, that's too fast. We have to do something. And typically what they will do is they will slowly start to raise the interest rates about a quarter of a point, 0.25 basis points or 25 basis points. So they'll raise it a quarter of a percent at a time, just a little bit here, a little bit here, a little bit here, nothing major, but just a little bit at a time to help bring that inflation back down. Now they waited this last time until it was over almost 6.5% to do something. They waited way too long. Nobody understood why. Waited way too long, which is why the markets are crashing right now, because they have to raise interest rates so heavy. And so they waited too long. I'm not sure why they did it. They just did it. Normally, historically, when that number is over 3.5%, they start taking little steps. They stop printing as much money. They don't give as much money. It's called the tightening of the money supply, monetary policy. And at 3.5%, then they'll actually start to raise the interest rates about a quarter, just a little teeny bit to offset that. And that brings us back down to about 2%. Currently, we're at 8.6. Heavy, way too high. And so the Fed, that's why the Fed's raising interest rates 3/4 of a point at a time right now, 75 basis points, because they got to get this number here back down to a manageable number. And then so they can eventually then get it back down to 2%. Now, if they do too much, don't give any money to banks, and they just say, we're going to raise interest rates, up to 10%, then we're going to go into a recession because it's going to be too much damage all at one time. So the Fed's trying to just punish the markets a little bit at a time to bring them back down. And that's why they're raising interest rates right now. And they're doing it because the inflation is too high. So when you see inflation get above 3.5%, know the Feds are going to start taking action by raising the interest rates. Those are our first two. Got two more, and I'll show you exactly what to do after these next 2 or 3 here. Where are we at on time? Oh, we almost went an hour here. Next, you're going to go pretty quick. So 10-year Treasury bond. 10-year Treasury bond is the U.S. government's way of saying, I need money. The U.S. government overspends. They don't have enough money. So they overspend. They say, I need money. So they ask for people to loan money to the U.S. Treasury Department. You might hear the term a 10-year bond, 10-year note. It is actually called a note, but you hear the 10-year bond all the time. Bonds are usually 10 or 20 to 30-year loans. But you see all the time. So the 10-year note is essentially it's a loan made to the U.S. government. It's generally purchased from large corporations, fund managers, pensions, and other companies. So if you run a large corporation like a pension plan or something like that, or have an annuity, and you want to make sure you get guaranteed money, you will loan money to the U.S. government. So you buy a note. So it's called purchase. But really what you're doing when you buy that note, you're loaning money to the U.S. government. And that money is paid out different than a normal loan. It's paid out with interest payments. So if they say that the yield on the 10-year note, which is right now 3.3%, in other words, if you loan the U.S. government money, they guarantee you 3.3% interest per year on that. And they pay it out every 6 months. So it's paid out on a 6-month basis. So every 6 months, they give you a dividend payment, which means it's the interest at 3.3%, but paid out twice over 1 year, a year at a time on a 10-year note. So you're loaning them money for 10 years, and every 6 months, they pay you half of 3.3%. And at the end of the 10 years, they actually give you the entire amount back that you loaned. That's how the U.S. government works out. Now, here's why this is important. When we kind of go back now, let's go back to here. By the way, 10-year, let me go back. I'll come back to this one here. Now, when the 10-year bond, when the CPI starts getting above 3%, everybody knows the Fed's going to have to take action by raising interest rates. When they raise interest rates, they're trying to stop people from spending money. People don't spend money. Companies don't produce the goods and services. People get laid off, and companies don't make as much profit because nobody's buying. At that point, the stock market starts to drop. So when we see the inflation start getting above 10 or 3.5%, we know the Fed's going to raise interest rates and the stock market's going to start to drop. When that happens, all the big money managers, pension funds, hedge funds, insurance companies, investment banks know the stock market's going to drop. So they start selling the stocks that they own in large quantities, which cause the stock market to drop. And at that point, they buy bonds. The bonds are guaranteed money because they know when the stock market drops, they're going to buy a bond and they're going to be guaranteed that 2, 3, 4, 5% a year interest on that money. So what you're going to see then is the bond market's going to start to go up as we're attracting investors. And right now we're over 3%, 3.3%. When it gets back down under 2%, when it gets back down under 2%, at that point, the stock market will start to stop dropping. What that means is people are selling their bonds, they're moving out of the bonds, they're selling, and they're going back into the stock market. So what will the rise in rates do to the deficit? Will that impact the market? So not the rise in rates isn't the deficit. The deficit is whether or not we spend too much money. So that's really what the deficit is on that. If we spend too much money, that's our deficit. At that point, will the institutions buy bonds, which is the loans that are kind of out there. They always say the stock market adjusts 6 months in the future. That is true. Stock market takes a while for it to go back and adjust. So now let's go back to where we're at here, our 10-year bond. The 10-year Treasury yield is a yield government base used as a proxy for mortgage rate. This is why this is important as well. The 10-year note, or the 10-year bond, which is what it's called generically. The 10-year bond is used as a proxy to help figure out how much the mortgage rate is going to be. So if the 10-year note is increasing or decreasing, it's kind of telling you whether or not home prices are going to increase or decrease based off the interest rates. So that's kind of an important note to go back and follow. Used as a predictor of future market moves, 2 to 3, 4%. If we can get it under 2%, the stock market's going to start dropping again. And that's what we're after. The higher it goes, 3, 4, 5, 6% above here, understand the Fed's doing things. They're trying to hurt the market at that point in time. We want the 10-year note to be under 2%. So here's what we're after. If the Fed is raising interest rates because the CPI is increasing and is above 3.5%, we will then see at that point the Fed raise interest rates, which will cause the institutions to sell stocks long term and move into the Treasury yields over through here. When all that happens, we can see stock markets are going to drop for us longer term. When is that going to stop? When the Fed stops raising interest rates and we see this number here, 6%, go to 7 to 6 to 5 to 4 and start working back to 3.5%. So when the Fed stops raising interest rates, actually this number starts to decrease and the bond yield starts to drop under 2%. At that point, you've hit a bottom in the stock market and it's okay to start buying again. And then this number here will continue to drop. And the Fed at that point might even start to lower the interest rates a little bit, a quarter basis point or 1.25 basis points at a time, which is 0.25%, start to lower it. And at that point, the stock market should start to rally. So that's what we're looking for long term. So you guys got that? I know it was a lot. Watch it again, watch it again, watch it again, write it on a piece of paper, stick it next to your computer and look at it every day so it starts to make some sense. And when you have that, you'll know, hey, what's happening in my portfolio? I'm about ready to retire. Now's not the time to retire because your portfolio is going to keep on dropping. And you don't want it to drop while you're still retired. You want it to drop while you're working because you got some more money coming in. But at the very least, we could say, maybe I should be in cash. So how do we use that? Number one, get out of your mutual funds. Horrible investment. No longer a very good idea. So here's what we're after here. Get out of your mutual funds. A lot of people say, well, my mutual funds are okay. No, mutual funds by default are required to keep the majority of all funds invested at all times. So when we know the stock market's going to drop, your mutual fund is guaranteed to lose you some money because they're not allowed to sell everything that they own because they own way too much of the marketplace. So they're required to keep the majority of all funds invested at all times. They'll sell a lot to cause the market to go down, but they still have to be invested at all times. But they still have fees, and the fees are horrible. So you want to move into an ETF instead, which is an exchange-traded fund. So you want to go back and watch some of our other recordings here that we've done with Protect Wealth on what is an ETF and how does an ETF work. It's just a mutual fund that trades on the stock exchange, and the average fee is about 0.25% or lower on the average fee, where the average mutual fund fee is over 3%. Even if they say it's a low load fund, it still has operating costs, investment advisory fees, marketing, distribution expenses, brokerage fees, custodial fees, transfer agencies, legal accounting fees. Typically, it's all paid out of the fund's assets. They say, oh, there's no fees. They're there. You just don't see them because they take them out of the fund's asset. They don't classify it as a fee. You get additional fees under annual fund operating expenses, management fees, bonuses, distribution fees, other fees. All funds have fees, but the average fee for a mutual fund is over 3%. The average fee for an ETF is under 0.25%. Do CNBC contributors know these situations since they like to ask Powell questions on how he's doing? Yeah, they know the answers to this stuff. They're pretty smart at what they do. But again, CNBC's whole job isn't to educate you. Their whole job is to get as many people to watch the TV show as they can so they can sell advertising. That's their job. So they'll do different things for different reasons. But yeah, they know the answers to all this stuff. But sometimes they don't want to give you the answer because they'll say, what's the headline right now that's giving you more sensationalism, gets more people to watch? And that's what they're going to hit over and over and over and over again. All right, so now here's how we do that. So what does that mean for us as investors? It means you can still invest, but it's a very simple process here. So we're going to start going back and show you what it is to do. So when you know right now the stock market's going to drop because everything still says it's dropping, and until we see that the Fed stops raising interest rates, until we see that the bond yield starts to go backwards from 3.3 to 3 to 2.75, 2.5 starts to drop on us, until we see at the same time the inflation start to decrease, the stock market's going to keep dropping. but we need to see all those start to work backwards, and then we'll start to find a bottom. It's not going to be a pretty picture. It's not going to be in one day. It's not going to have big up and down days because it is. But at that point, long term, we should start dropping. And then we start saying, let's start looking for some better quality investments right through here. Other than BLS.gov, BLS.gov is the best place for just your CPI number. And then from the CPI number, you can just go back at any given time, just do a Google search and say current Fed inflation rate. And they'll just tell you they're raising it, and they expect to raise it here, 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 all the way through here. And then the 10-year bond is on our website, it's on CNBC, it's all over the place. So now, let's see what it is we're looking at right through here, and let's go through the process. And here's what we're after. So I'm going to go over to our website through here, and I'm going to start on the left-hand side of the page where it says asset allocation. So this is what we want to do. When the market stops dropping, just kind of like what we were taking a look at, and we just kind of covered the items we're after. When inflation, CPI number starts to decrease, when the Fed starts only raising interest rates a quarter of a point, and they get done with the 3/4, get 1.5, quarter point to zero, no more interest rate increases. And at that point, when we see the bond yield start to drop, we can go back into the market. Here's how we're going to do it. We click on asset allocation. Now I'm going to ask some questions. They'll say, how old are you? And you're going to type in an age, whatever age you are. When do you want to go back and retire? It's the exact same questions that the bankers will talk to you when you go and say, I want to open up an IRA, or I want to have somebody manage my portfolio. Same exact questions. Would you like to be an aggressive or conservative portfolio? The younger you are, aggressive. Typically about the time you hit 59 or 60, you go to a conservative portfolio, which means I don't want to be in aggressive positions. What's the current value of your portfolio? Let's just say it's I'm just making up numbers here, right? And I'm just saying, what if you have a 401k or an IRA? Let's say it's 200,000. You can say it's 50. Put in the number here. Do you want to add any additional funds per month? Let's say I want to add in $200 a month extra into my portfolio to see where it's at. Then click right here. It says calculate the breakdown, and it tells me by each age of where I'm at, if I kind of readjust each age based on my age and how much is in my portfolio, if I readjust it once a year, I should have at the very end of the year here, approximately in my account, $743,000 to retire off of. Starting with $200,000 and adding $200 more a month here. I should have approximately $700,000 to retire. Now here's what's interesting. This, by the way, is if you do it yourself. If you have somebody else manage your portfolio and they're only going to take a 1% management fee, that same $743,000 is $579,000 because you have somebody else do this for you, which I think is crazy. Why would I pay somebody where I could make 743, but I'm only going to get 579 because they do this? And here's all that they did. They just answered these basic questions up on top, and then from here they scroll down. Equity ETFs, 44% of my portfolio for $88,000 should be in equity ETFs. 21% or $42,000 should be in international equity ETFs. All that means is click here to see the international list of international equity ETFs. So you click there and you just scroll down, and these are just a list of the international ETFs. These are mutual funds that trade like a stock, and you're just going to go down until you find one that you like on a trend. Okay. Scroll down until you find something you might like. First you look, okay, here's, and kind of go down. And you're just looking for anything here that happens to be in an uptrend that you like. Looks like China's right now the ones that have the best trends on them, but you go back and say, okay, large cap ETFs, iShares for China, large cap China stocks. Average volume is trade about 20 million shares a day, pays a cash dividend just because you own it, an extra 1.88%, but it's in an uptrend. So you go back and say, okay, I'm supposed to spend $21,000 on international ETFs. That's part of my portfolio. I should have some if I kind of go back to where I was just at. Just kind of go back to where we're just at over here. And it just says in my portfolio, I should have about $88,000 into stock funds. These are just ETFs that hold stocks. 42,000 into international equity ETFs, 14,000 into bond funds, 36,000 into income funds. These would be dividend paying ETFs, 20,000 into REITs, ETFs that hold REITs. And so you just go back and click on the list and say, okay, which one of those do I like? You say, okay, I'm going to spend $42,000 here. And so, okay, this one here is approximately $33 a share. How many shares do I get to buy if I've got 42,000? Now you're diversified in here. You're in an entire country, but you could say, I want some Chinese funds, and maybe I want some Brazil funds, and maybe I want some Japan funds, whatever it is. Find the ones that are in an uptrend. That's all that we're after. I just don't want to own one that's in a downtrend because I'm losing money. And then once you buy that, you do it once a year and you're done. Now you take that ticker symbol, whatever it might be, and you go over here to your watch list and click on the watch list. And then you type in that ticker symbol, whatever it is that you just bought. So you type it in right through here, add it to your watch list, and then on the watch list, take a look at it. And then whenever that stock that you've got in your watch list starts to drop and starts making lower lows because it's now in a downtrend, we will send you an automatic email and a text saying, hey, the stock that you have in your portfolio is starting to drop. I want to go back and sell it. Then just leave the money in cash. You don't have to do anything else if you don't want to. But then once a year, you come back to that same portfolio and you do the exact same thing that I just did. And you just go back and say, okay, I'm now going to go back and say, I'm now 46 years old and I still want to retire at 65. And now the current value of my portfolio is right now about $215,000, and calculate the breakdown. And it just says you should now have about 103,000 into equity ETFs, just ETFs that own stocks. Where's a list of those? Right there they are. Go back and find ones in an uptrend. They're all good. They're all diversified. They all own great, big, huge stocks. Like they all own the Googles and the IBMs and the Teslas and all great, big, huge companies. So which one do you want? I want the one that's heading higher. And you buy those ones and you should have about $103,000 invested. Just buy one or two. You don't have to have a whole bunch because each one is diversified. One or two here, one or two here, one or two here, one here, one here, and you're done. You do that once a year. And then you go back and put them into your watch list. And whenever they start to drop, we'll send you an automatic email and a text. Your stock is dropped, and go back and sell it. And then you sell it. You can go back and look for another one. If you sold one from the international equity ETFs, click here again, and then go back and find another one you want, or just leave it empty. And next year, just do it again. Do that once per year, all you have to do. And by you doing that, you're going to save, go back up here, what's going to be if we save that? You're going to save $743,000 to $585,000. So you're going to save about $150,000 because you do this yourself once a year. Or you can pay somebody to do it, and that's only 1%. Good money managers are going to charge you 2%, but they're also going to put you in mutual funds, which is another 3% on top of that. Imagine what that's going to be. Making money isn't difficult. It's just different. So if we look at the things we just talked about, look at the CPI, inflation, because that'll tell us what the stock market, the Fed's going to do, raising interest rates. If they raise interest rates, that'll cause the institutions to sell stocks and buy bonds, right? And that'll cause the stock market to go down. So okay, take a look at those. And then when all those start to go backwards on us, the stock market will have hit a bottom and longer term will start to go back up. That's when you start investing. In the meantime, if it was me as an investor right now, I'd be out of most of my positions right now. We had a nice little bounce today, but we're not out of the woods yet. I mean, the interest rates are still rising, right? Which means the markets are still going to drop. The 10-year bond is at 3.3%. It's not dropping. It's still going up a little bit. The inflation's still going up. Everything still says we're negative. So if it was me, I'd be in a lot of cash right now until I see that. When I see that, now go back in the stock market. And you're not going to time the bottom perfectly, but you're going to miss the big drop. And you're going to be back in the market for the longer term gains as we start going forward with that. So that's what I got, Kendall. I know I went a little teeny bit long. We're supposed to only be an hour here, but such fascinating stuff here. When you understand, and I'll give you just a tip of the iceberg here, just a little bit. When you understand what's really happening in the stock market, what drives the stock market, it's actually a pretty simple process of what to do. At some point, then you'll just get much better at exactly when do I buy, how do I make the maximum amount of profit on each item, and exactly when do I sell, and how do I fix and repair bad trades. That all comes separate. But if all you're doing is just doing a better job managing your portfolio, and nobody in your financial markets or your broker or your money manager is telling you anything other than don't worry about it, turn that for the long haul as they keep getting paid, I'd fire them and say, I can't do a worse job than they are. If all you did was just follow what I just did, this very last part here, follow what I just did, you can't do a worse job. It's pretty difficult. So that's kind of what I have for you guys. You can get out of your dividend kings and aristocrats because even though, Tamara, you're getting paid with your dividend kings on there, you're getting paid. I doubt the amount you're getting paid, even if it's 4%, has overshadowed the 20% loss in the stock market. So even though, I mean, it does help offset that, so you're not losing as much, but I'd rather just be in cash right now versus a drop in the stock market. And then when I see all those signs come back to use, jump back into whatever else you want. You buy some dividends at that point and some good growth stocks at the same time that are completely undervalued at that point in time. So, Kendall, I see you back online there, buddy. I see you. I hope that was some good information. And guys, what I just did here is extremely valuable. You will use that for the rest of your life. And not only will it help you do a better job than the money manager is doing for you, because they can't sell like right now. You can sell, they can't sell. They're not allowed to. It's going to give you the confidence knowing that I'm no longer afraid. And when you're no longer afraid of the stock market, you're just, everything opens up for you, a whole new world for you. So, go back and watch this again and again. Protect Wealth has got some great videos. Go back and rewatch this stuff. And it'll change your mindset for the stock market. And then from that, as you get good at that, then come back and get good at a whole bunch of other things to give you much more monthly cash flow from the stock market. We've got those for you as well.
So, Mike, you are so amazing. I learned a ton on this. I hadn't gone that in depth on the Fed. It's like for the people, by the people, what happened to that? That's all gone. It just is crazy, Yeah. So do you mind, Mike? So I know we're going to get a lot of questions. Everyone wants to know how to access you more. So they want to know more because, Mike, clearly you understand what you're talking about. Most people never dig in and learn this. So I know you do offer workshops and trainings. You do have some coming up, right?
Yeah, we got one coming up here. This next one here is June 25th and 26th. And we have one usually about once a month. So whether it's this one or next one, if you're watching a recorded version of this, we've got one once a month. But if you just go to protectwealth.com/stocks, which is the stock portion of the training here, you'll see the link to go ahead and register for that. And so it's $197. It's always been $197. Protect Wealth always has great prices for all of their tuitions for all their students through that. But it's a 2-day live class. And in a 2-day live class, I'm going to give you a set of videos to watch ahead of time on cover calls, a set of videos for getting your teens involved in the stock market as well. But we spent 2 full days kind of covering what I just did here in much, much more detail, as well as showing you how to create some monthly income off of those same ETFs to bring in. So you've got long-term growth, but you can get some monthly income off those as well. So we'll do a little bit more in depth on 2 sources of income from them. But yeah, 2-day class. We have one this weekend, Saturday and Sunday, the 25th and 26th of June.
Oh, that's this weekend. That's right. So a lot of the new students on here may not know. So it's $197, and that's for you and a guest, correct?
It's for you and a guest, and it's for 2 months access to the website. After the 2 months access to the website, it's just $24.99 on a month-to-month basis.
So unreal, Mike. You and I have been around in the kind of like education space, and there's been a lot of education opportunities and different trainings and different things. This is not that. I'm telling you right now, this is not that. And especially the thing is, at $197, that's unheard of. I don't know. A lot of our students may not know that. That's not something you used to do in the past. Something like this used to cost thousands to attend now. So that's a great deal.
It's just economies of scale, and the internet just made everything we're able to do now with the internet you just couldn't do years ago. But we can do all kinds of cool things, so it just made it much cheaper for everything these days. And then once you have the knowledge, you have it forever. It's just one of those things that nobody can ever take away from you. The biggest thing we get from most of our students is, aside from the monthly cash flow, which they just enjoy, is the fact that they feel at peace now about what they can expect in the future with their money, knowing, am I going to be able to retire? How much money will I have? And do I have to be fearful and panic when I see, the whole stock market crashing like this because of inflation? When I hear those terms, and the answer is you don't have to be fearful anymore, because there's certain things you can do. And in the class, we're actually going to show you how to make money when the market drops. I just only had so much time in today's class. We couldn't overload you too much, but you gave me 2 days to go to cover that. So
it's unreal, Mike. So the thing is, a lot of people have invested in 401ks, their different type of retirements account, and they're paying, and they don't know, like you said, they don't know the fees they're paying, which ends up being a massive chunk of your retirement over the years. Even 1 percentage point gets you tens of thousands of dollars in the long run, like you said, if you're just sitting there, let it do. It's huge.
We were looking at this. If you're only paying 1 percentage point on that portfolio, it went from almost 750 to $585,000. That's a huge chunk of change that somebody's going to keep for themselves, because they told you that you weren't smart enough to do it by yourself, and you believed them, so you got a job, and you gave them your money, and they just did what I did here in the last 10 minutes of this presentation. They did it once. They do it once a year, and you pay them about $150,000 to do that for you, which to me is asinine, just crazy. And
it is unreal, because you can do that. It is simple. I get it. Sometimes it's hard when you do it yourself, but it is very simple when you've done it. It really, really is. Once you're in there and doing it, it's amazing how simple it is. So I'm just talking about scale here. You're going to pay them tens of thousands of dollars, if not hundreds of thousands of dollars in your retirement account if you're not paying attention, and most people aren't. So $197 for your workshop, I'm telling you, that is everybody on the call. That's a major, major deal. Mike, we can't thank you enough for that offer. That really is. Seriously, we appreciate that offer. That's a screaming good deal. So thank you. Thank you. I put it in the chat. It's clickable, protectwealth.com/stocks. Click it and sign up. I couldn't recommend it more. And I wish our students could see your reviews, Mike. Seriously, I've known you, 10 years plus now?
Here's how you get the review. Come to the class. If you don't like the class, at the end of the class, tell me you want $197 back, I'll give it back to you. And that's the best review you can get.
That's true.
You don't even have to tell me why. You can say, Mike, you were in the class and I didn't like the color of your hair because it's too gray. I'll say you get your $197 back.
Well, we get a lot of reviews, and I wish our students could see those too a lot. We literally, when we do these events, we get a lot of reviews, people saying they've done your trainings and education, and they've made, and I hate saying big numbers, Mike, because I know that sounds like crazy, but people have said hundreds of thousands, tens of thousands they've made over the years with your trainings, if not much more. And we have seen that consistently. So I can't recommend it enough. Mike, we've known you for years and years and years. It's true. It does what it does. So thank you. Thank you for that offer. So there's a lot of questions coming in. Do you want to do more of them, Mike? I know there's a lot of people are staying on. If you want to jump in and take them, let's do it.
Yeah, for the class is this Saturday and Sunday, the 25th and 26th from 9 a.m. till 5 p.m. or 11 a.m. till 6 p.m. Eastern time. So it might be different based on where you live, but it's 11 to 6 Eastern time through there. Saturday and Sunday. You have 4, the Fed, CPI, the last one is the S&P 500 PE ratio. Anything under 16 is good. Anything above 16 means stocks are overvalued and they're going to have to drop. So I just didn't have time for that. The last one here for Crystal is the S&P 500 PE ratio is the last item that we're just kind of taking a look at. So I can show that one just real quick, and then I'll take a few more questions here. And let's go back to my members area.
Why I'm pulling that up, Mike, a lot of people are asking if this is recorded. Yes, it's recorded. We will send it out. As long as you're on the call and or registered for the webinar, we will send this out to you. But also make sure you're signed up for our YouTube channel, because we post it there. You can get it.
Yeah, it'll be posted there for you to go back and watch. I've got some other videos there as well, but you've got a bunch of other great content there with Scott Estelle and some other people too. So really good channel if you guys haven't been over to the Protect Wealth YouTube channel.
Yeah, we have Mike doing karaoke on one. It was amazing. Dancer. No? Okay.
Yeah. So Bob, your question, would I buy any inverse funds right now? Inverse funds will probably still go up for another month or two. So I would, anytime you get any kind of a little pullback on those, it might be a good idea to jump into some inverse funds, but don't hang on to them for too long. But if you're already retired, Leela, if you're already retired, you can still go back and use that retirement calculator, but you just have to say you want to retire at an age older than you are today. So let's say you're 65, put in 66, 67, 68. It'll still give you the breakdown throughout there. Okay. I think that was the rest. It was just more about the recording. Everybody wants to have the recording. Yeah, and I get it, guys. I talk fast. That was a really good amount of information I gave you. You do want to go back and re-watch those. Go to the YouTube channel Ken was talking about. Watch it. Write the things down that I talked about, and then put them next to your computer so you can look at them. Every day. They'll just be ingrained in your memory, so you'll know it going forward. Everything you do that, and you're going to find every time you now turn on the TV set and you hear them talking about the Fed or the monetary policy or interest rates or the bond yields or PEs, you're gonna that makes perfect sense, and you know exactly why they're talking about it now. Yeah.
It's amazing because you can know what directions it's going to go. That's really neat, Mike. Just from that perspective alone. I know you can't time the market. Everyone says you can't time the market. I get that. It's not 100%, but man, you can certainly understand where it's going. I love that. Thank you very much.
Okay, thanks. I got one here. What do you do to get in 10-year bonds? They have ETFs that track the 10-year bonds. So you might want to track that instead. And that's on our website. You pull up the bonds for that. So I'd go with that, because you're not going to be able to give $200 million to the U.S. government for a bond. So just buy an ETF that tracks the price of the bond instead. Okay, that's all I kind of have tonight, Kendall.
Thanks, Mike. Okay. Very good information. I learned a ton. Like I said, if I knew a fraction of what you knew, man, I'd be better off, Mike. Thank you so much. Again, thanks for your time. Great workshop tonight. We will have this posted shortly, probably tomorrow afternoon. If you guys have any questions, let us know. Better yet, sign up for Mike's workshop. Like you said, it's guaranteed. If you don't like Mike's color of his hair, you can return it. So
I like the color of my hair. I don't have a problem with it. It's gray. Just in case you guys don't know, it's gray. I'm 59 years old.
I'm getting there.
That color, but it got there.
That's called kids, Mike. I'm getting there too.
That's a good guy.
Thanks again for your time tonight, Mike. We really do appreciate your time. I loved it. Great information.
All right. Thanks, Kendall. Thanks, everybody, for being here tonight, and hopefully you'll be able to use this going forward. So I'll see you online. Bye-bye.
Thanks, everybody. Have a great
Thanks, Mike.
We'll see you soon.